Gold and silver are regaining momentum right now as metals stabilize across global markets, while the Federal Reserve inches closer to rate cuts that could fundamentally repricing precious metals and reshape safe haven positioning for investors who have watched volatility shake out weak hands over recent months. And what we're witnessing in this exact moment is not random noise, but the early structural shift that historically precedes major reallocations into hard assets when central bank policy pivots from restrictive to accommodative, and the smart money is already repositioning quietly while retail investors remain distracted by headline volatility, missing the underlying accumulation pattern that's forming beneath the surface as gold finds support above key technical levels and silver refuses to break down despite relentless pressure from a dollar that's showing cracks in its own foundation. The Federal Reserve is now cornered by slowing economic data, persistent inflation that refuses to return to target, mounting debt service costs that are consuming larger portions of the federal budget, and political pressure building from every direction as recession fears collide with inflation realities, forcing policymakers into a monetary trap where rate cuts become inevitable. Not because inflation is defeated, but because the economy and the government's own debt burden cannot sustain restrictive policy much longer. And this is precisely the environment where gold and silver historically reassert their role as wealth preservation tools and inflation hedges that protect purchasing power when confidence in central bank omnipotence begins to erode. Right now, gold is stabilizing after a period of consolidation that flushed out over-leveraged speculators and short-term traders, leaving behind a more resilient base of long-term holders, institutional buyers, and central banks that continue accumulating regardless of short-term price swings. And the fact that gold has held these levels despite a stronger dollar earlier in the cycle tells you that demand is shifting from momentum-driven speculation to genuine safe haven positioning, the kind of accumulation that doesn't scream on CNBC, but builds silently in the background as wealth managers, pension funds, and sovereign entities quietly increase their exposure to physical metals and mining equities. Silver is following a similar pattern, but with even more explosive potential because it sits at the intersection of safe haven demand and industrial necessity, acting as both a monetary metal and a critical component in solar panels, electric vehicles, defense systems, and electronics, which means silver faces dual demand pressure from investors seeking inflation protection and manufacturers requiring physical metal for production. And the supply side remains constrained with primary silver mines declining, byproduct production dependent on base metals that aren't growing fast enough, and above-ground inventories depleting at exchange warehouses while premiums for physical metal remain elevated compared to paper prices, signaling that the real metal is tighter than futures markets suggest. The rate cut narrative is accelerating faster than most investors realize because the Federal Reserve's own language is shifting from higher for longer to data-dependent flexibility, which is central bank code for we're preparing to pivot, and the market is already pricing in multiple rate cuts over the next 12 months. As economic data softens, employment numbers lose momentum, consumer spending shows strain, and corporate earnings guidance turns cautious, all while inflation remains structurally elevated above the Fed's 2% target, meaning the central bank will likely cut rates into an inflationary environment rather than after achieving true price stability. And that scenario is rocket fuel for precious metals because it accelerates the negative real rate environment where the inflation-adjusted return on cash and bonds turns deeply negative, pushing capital toward assets that preserve value rather than guaranteed erosion through currency debasement. The dollar is looking increasingly vulnerable despite short-term strength because the structural forces weighing on U.S. currency dominance are intensifying, from rising treasury yields that make debt service unsustainable, to geopolitical fragmentation that's driving nations toward bilateral trade agreements bypassing the dollar, to central bank diversification away from dollar reserves into gold, euros, yuan, and other alternatives. And while the dollar may experience tactical rallies during risk-off events, the long-term trajectory is clear as fiscal deficits widen, political dysfunction paralyzes Washington, and America's debt-to-GDP ratio climbs toward levels historically associated with currency crises in other nations. And when the dollar finally loses its bid, gold and silver will reprice violently higher as global investors scramble for assets that aren't somebody else's liability. Inflation is not defeated, it's simply paused. And the structural drivers that pushed prices higher over the past several years remain embedded in the economy, from deglobalization and reshoring that increase production costs, to energy transition investments that require massive capital expenditure, to labor shortages and wage pressures that feed into service inflation, to government spending that shows no signs of fiscal discipline regardless of which party controls Congress or the White House, and the Federal Reserve's attempt to normalize inflation through rate hikes alone was always insufficient without addressing the supply-side shocks and fiscal dominance that are the true engines of persistent price increases, which means the next wave of inflation could arrive faster and harder than the first, because the system is now primed with excess liquidity, fragile supply chains, and diminished policy tools to fight it. Retirees and savers are facing a silent wealth destruction crisis that most don't fully comprehend, because while their account balances may look stable in nominal terms, the purchasing power of those dollars is eroding month after month as inflation runs hotter than the interest earned on savings accounts, money market funds, and even short-term bonds. And this negative real return environment punishes those who play it safe in cash, while rewarding those who position in real assets like gold, silver, real estate, and commodities that appreciate alongside or ahead of inflation. And for retirees living on fixed incomes, this dynamic is particularly devastating because every year of inflation above their income growth rate permanently reduces their standard of living, making precious metals allocation not a speculative gamble but a defensive necessity to preserve decades of accumulated wealth against policy mistakes and currency debasement. The window for positioning is narrowing because precious metals bottoms don't announce themselves with fireworks and CNBC alerts. They form quietly during periods of doubt and frustration when sentiment is poor, headlines are negative, and most investors have given up or are waiting for one more dip that never comes. And by the time the mainstream financial media starts celebrating gold's breakout and silver's surge, the easy gains are already gone and latecomers end up buying near interim tops, which is why understanding accumulation phases and recognizing when smart money is rotating into assets before the crowd arrives is the difference between building wealth and chasing rallies. Technical patterns are aligning bullishly across both metals as gold consolidates above support levels that have held through multiple tests, forming a base that typically precedes upside breakouts, while silver is coiling in a tightening range that suggests energy building for a directional move. And when silver finally breaks out, it tends to move with far more violence than gold because of its smaller market size, higher volatility, and the leverage it provides to monetary trends, and the gold to silver ratio remains elevated by historical standards, indicating that silver is still undervalued relative to gold and offers asymmetric upside potential for investors willing to tolerate short-term volatility in exchange for long-term outperformance. Central banks continue buying gold at record pace, adding hundreds of tons per quarter to their reserves in a coordinated global shift away from dollar dependence and toward hard asset diversification. And this buying is not speculative or price sensitive, it's strategic and persistent, providing a floor under gold prices and signaling to observant investors that sovereign entities with access to the best economic intelligence are choosing physical gold as the ultimate reserve asset. And when central banks vote with their reserves, private investors should pay attention because these institutions are preparing for currency instability, geopolitical shocks, and financial system stress that may not be visible in today's headlines, but are clearly anticipated by those with insider perspectives. Mining equities remain historically cheap relative to metal prices, offering leveraged exposure to gold and silver price appreciation with the added benefit of operational improvement, cost control, exploration upside, and dividend potential. And while mining stocks carry operational and geopolitical risks that physical metal does not, they also provide the opportunity for multiples of return when metal prices rise because profit margins expand exponentially as revenues increase while costs remain relatively fixed. And the best managed mining companies with strong balance sheets, low-cost production, and growth pipelines are positioned to deliver extraordinary returns during the next leg of the precious metals bull market. Geopolitical instability is intensifying across multiple theaters from Eastern Europe to the Middle East to tensions in the Pacific, and each flashpoint carries the potential to disrupt global trade, spike energy prices, trigger currency volatility, and drive safe haven flows into gold and silver as investors seek assets that aren't tied to any single nation's political or economic stability. And history repeatedly demonstrates that during periods of war, sanctions, trade disruptions, and geopolitical uncertainty, precious metals outperform virtually every other asset class because they represent universal value that transcends borders, governments, and fiat currencies. The bond market is flashing warning signals that most investors are ignoring, with yield curve inversions, rising long-term rates despite Fed policy, and growing concerns about Treasury auction demand as foreign buyers reduce their holdings, and domestic buyers demand higher yields to compensate for inflation and fiscal risk. And when the bond market loses confidence in a government's ability to manage its debt, the currency and the entire financial system come under pressure, forcing central banks to choose between defending the currency through tight policy that crashes the economy or defending the economy through loose policy that crashes the currency. And neither option is bullish for paper assets, but both are extraordinarily bullish for gold and silver. Physical premiums on coins and bars remain elevated above spot prices, reflecting strong retail demand, supply chain constraints, and delivery delays that indicate real-world tightness in the physical market, even when paper prices appear subdued. And this disconnect between physical and paper markets is a recurring theme in precious metals, where futures exchanges can suppress prices through leverage selling, while physical buyers absorb available supply, creating a coiled spring that eventually snaps when paper market participants demand delivery or when new investment demand overwhelms available inventory. Institutional investors are quietly increasing precious metals exposure through ETFs, mining stocks, and direct bullion holdings, recognizing that traditional 60-40 stock bond portfolios are inadequate for an era of persistent inflation, negative real rates, currency instability, and geopolitical chaos. And the 5 to 10% precious metals allocation that was once considered fringe is now becoming mainstream portfolio management, as wealth advisors acknowledge that gold and silver provide diversification, inflation protection, and crisis insurance that no other asset class can replicate. The psychological shift is underway from viewing precious metals as relics of the past to recognizing them as essential portfolio components for the future. And this shift is being driven not by gold bugs or conspiracy theorists, but by sober analysis of fiscal trajectories, monetary policy exhaustion, inflation persistence, and geopolitical fragmentation that together create an environment where hard assets outperform financial assets. And those who position early in this transition will build and preserve wealth, while those who cling to outdated investment paradigms will watch purchasing power evaporate. The convergence of factors right now, stabilizing prices, impending rate cuts, persistent inflation, dollar vulnerability, central bank buying, geopolitical tension, and institutional rotation creates a setup that happens maybe once or twice per decade, and waiting for perfect clarity or mainstream confirmation means missing the accumulation phase and buying into the momentum phase at far higher prices. And the investors who profit most from these macro cycles are those who recognize the early signs, trust the structural analysis, and act while uncertainty still clouds the narrative and prices remain accessible. This is not about gambling on overnight riches or chasing meme stocks. This is about understanding how monetary systems work, how central banks respond to crisis, how governments manage unsustainable debt, and how hard assets preserve wealth when paper assets lose credibility, and gold and silver have played this role for thousands of years across every empire, currency, and economic system, because they represent tangible value that cannot be printed, debased, or politicized. And that fundamental truth becomes increasingly important as modern monetary experiments push deeper into uncharted territory with unpredictable consequences. The next 12 to 24 months will likely determine which investors positioned correctly for the macro shift and which remain trapped in conventional thinking that no longer applies to the current environment. And while no one can predict exact timing or price targets, the directional case for higher gold and silver prices strengthened by Fed policy pivots, fiscal dominance, inflation persistence, and geopolitical instability is about as strong as macro cases get. And the risk-reward clearly favors exposure to precious metals over complacency in cash or overvalued financial assets that offer negative real returns. Please remember that all content presented here is for educational and informational purposes only and should not be construed as financial advice, investment recommendations, or guarantees of future performance. Markets carry inherent risks, including potential loss of principal past performance, does not predict future results, and viewers must conduct their own due diligence. Consult with qualified financial professionals, and make investment decisions based on their individual circumstances, risk tolerance, and financial goals.